The investment thesis for Aker BP centers on its position as a high-growth, financially robust exploration and production (E&P) operating exclusively on the Norwegian Continental Shelf (NCS). The company leverages operational excellence and strategic alliances to execute a massive capital expenditure program, which is expected to translate into substantial production increases through the latter half of the decade. The Q3 2025 results exhibited a typical profile for an E&P entity in a peak development phase: strong operational cash flow generation coupled with statutory earnings impacted by high depreciation charges. Aker BP successfully generated $2.6 billion in revenue, surpassing the forecasted $2.52 billion won, while maintaining stable production at 414,000 barrels of oil equivalent per day (MBOPD). The key long-term catalyst remains the successful execution of the Yggdrasil development and associated projects, which will drive production from current levels to approximately 525 MBOPD by 2028-3, with output sustained above 500,000 barrels per day beyond 2030. Furthermore, the company's industry-leading low emissions intensity provides a strategic competitive advantage in an increasingly regulated European energy market.
The analysis concludes that Aker BP represents a compelling investment opportunity, primarily due to the current market valuation failing to fully discount the volume and quality of future production enabled by the Yggdrasil project. While the analyst consensus remains neutral 5, primarily due to near-term execution risk and capital intensity, the combination of an attractive last 12 months LTM enterprise value to EBITDA EV/EBITDA multiple of 2.2x 6, exceptionally strong balance sheet health, leverage ratio 0.49 7, and resilient dividend growth 5% planned increase for 2025 4 warrants a favorable rating. The low valuation, when judged on cash flow multiples, suggests the stock is currently undervalued relative to its demonstrable ability to sustain production and deliver massive organic growth. The upside potential significantly outweighs the manageable risks related to project execution. 2.1 NCS focus and competitive differentiation. Aker BP's strategic focus is confined exclusively to the Norwegian Continental Shelf, a premium basin characterized by favorable geology, robust regulatory predictability, and access to established export infrastructure. This geographic concentration allows the company to maximize operational synergies and maintain deep domain expertise. A key differentiator for Aker BP is its strategic alliance model, which management credits for driving execution excellence and disciplined cost control. 2. This model fosters deep collaboration across the value chain, extending to major suppliers and partners. By standardizing engineering designs and execution methods across multiple projects, the company reduces complexity and cost. This structure is integral to the successful advancement of the major field developments currently underway, including Yggdrasil, Valhall PWP Fenris, Skarv satellites, and Utsira High, all of which are reported to be advancing on schedule. 2. This strategic approach is viewed as a foundational strength, positioning Aker BP as the E&P company of the future through continuous adaptation, technological innovation, and a leading position in digitalization. 2.2 Macroeconomic backdrop and currency resilience. The volatile relationship between the US dollar, USD, the currency of oil revenues and financial reporting, and the Norwegian krone, NOK, the currency of local costs, creates specific financial translation dynamics. Aker BP reports its financials in USD. While oil and gas sales are primarily USD denominated, a significant portion of capital expenditures and operational costs are incurred in NOK. The Norwegian government's proposal for the 2026 national budget revealed that Aker BP's portfolio of ongoing development projects totals NOK $288 billion in gross investments. 9. This figure represents an increase of NOK $75 billion compared to original estimates. However, management provided critical context. More than one-third of this increase is directly attributable to the weakening of the Norwegian krone against the US dollar since the projects were initially estimated. 9. A crucial financial consequence arises from this currency dynamic.
Although the weakening NOK increases the reported cost profile when translated into NOK, this has a limited impact on Aker BP's financial statements, which are presented in USD. Simultaneously, the stronger US dollar generates higher revenues when translated into NOK from the USD-denominated oil sales. This mechanism functions as a natural hedge, where the currency strength that inflates local costs simultaneously boosts revenue realization in the local currency. This interplay mitigates the adverse financial exposure of the core business to local currency volatility and ensures the project economics remain robust in USD terms, supporting the project resilience noted by management. 9. 3. Q3 2025 Financial and Operational Review. 3.1. Detailed Q3 Financial Performance Analysis. Aker BP delivered mixed financial results in the third quarter of 2025. Total revenue reached $2.6 billion, exceeding the forecast of $2.52 billion, representing a positive revenue surprise of 3.17%. 1. This achievement is attributed to strong realized commodity prices and stable operations. Conversely, the reported earnings per share (EPS) of $0.45 fell short of the forecasted $0.5484, resulting in a significant negative surprise of 17.94%. 1. This substantial disconnect between strong revenue and a statutory EPS miss is a common and often expected characteristic of E&P companies, particularly when they are executing large-scale, long-life development projects like Yggdrasil. The underlying financial reality is that the aggressive capital expenditure associated with these projects requires significant non-cash charges, primarily depreciation, depletion, and amortization, to be run through the income statement. These non-cash accounting provisions heavily reduce net income and, consequently, statutory EPS without consuming physical liquidity. The cash generation metrics strongly support the underlying profitability of the business. Cash flow from operations (CFFO) for Q3 2025 reached $2 billion. 1. This is a substantial quarter-over-quarter improvement from the $1.2 billion recorded in Q2. 2. The resilience and magnitude of this cash flow generation confirm the company's capacity to finance its dividend obligations and maintain high capital investment levels. For this reason, cash-based valuation metrics such as EV/EBITDA and CFFO per share are significantly superior indicators of fundamental value during this heavy development cycle compared to the traditional P/E ratio or statutory EPS. 3. 2. Production and cost control. Aker BP demonstrated strong operational discipline in the third quarter. Net production averaged 414 MBOEP, maintaining stability consistent with the 415 MBOEP recorded in Q2. 2. This stable output was achieved through high production efficiency and minimal unplanned downtime. 2. The company subsequently raised its full-year production guidance to a range of 410,000 to 425,000 barrels per day. 1. Underscoring confidence in operational continuity for the remainder of 2025. Cost control remained robust. The production cost per barrel of oil equivalent was reported at $7.06. 2. While this is a marginal increase from the Q2 cost of $7.03 per BOE, 2. Management attributed the increase to expected planned maintenance activities. 2. This cost level remains extremely competitive within the global petroleum industry, supporting high operating margins even during periods of moderate commodity prices. Capital structure and shareholder value proposition. 4.1. Balance sheet strength and leverage profile. Aker BP maintains an exceptionally strong balance sheet, which is a prerequisite for executing its ambitious capital program. The company reported net interest-bearing debt of $6.071 billion in Q3 2025. 7. Critically, the leverage ratio, net debt/EBITDA, calculated internally, stood at a very conservative 0.497, a marginal increase from 0.43 in the previous quarter, but still signaling profound financial stability. This low leverage ratio, significantly below 1.0x, is pivotal. Fitch estimates the company's EBITDA at around $8.1 billion for the full year 2025. 10. The strong current funds from operations (FFO) net leverage, which was 0.5x at the end of 2024, demonstrates effective debt management. 10. This financial strength provides substantial debt capacity, ensuring Aker BP possesses the requisite funding security to mitigate the substantial project execution risk inherent in the NOK 288 billion capital program. 9. The robust capital structure confirms the company's capacity to comfortably self-fund its massive growth trajectory without the necessity of material equity dilution or placing undue stress on its commitment to shareholder returns. 4.2. Dividend policy and growth commitment. A key component of Aker BP's value proposition is its consistent commitment to shareholder distributions. A dividend of 0.63 per share was paid in Q3 2025, keeping the company on track for a target annual dividend of $2.52 per share. 2. Furthermore, management has signaled forward confidence in its cash flow generation by planning a 5% increase in dividends for 2025. 4. This proactive dividend policy, supported by resilient cash flows, suggests management is highly confident in the future profitability and capacity of the major development projects, particularly Yggdrasil, to generate cash flows sufficient to bridge the current high capital expenditure requirements and sustain rising shareholder payouts over the long term. V. Long-term growth catalysts and reserve profile. 5.1. The Yggdrasil mega project and production trajectory. The centerpiece of Aker BP's growth strategy is the extensive portfolio of development projects, most notably the Yggdrasil complex. Current operations affirm that key milestones across all major field developments, including Yggdrasil, Valhall PWP Fenris, Skarv satellites, and Utsira High, are being achieved on schedule. 2. This timely execution validates the efficiency of the alliance model adopted by the company. The long-term growth outlook is compelling. The Yggdrasil complex and enhanced recovery measures across the portfolio are expected to propel Aker BP's net production dramatically from the current 414 MBOEPD to approximately 525,000 barrels per day by 2028. 3. Furthermore, the company maintains a strategic ambition to sustain production above 500,000 barrels per day beyond 2030. 4. The sheer scale of the Yggdrasil opportunity is reflected in the increased resource ambition for the area, now exceeding 1 billion barrels. 4. Underscoring the embedded long-term value. 5. 2. Exploration success and reserve value creation. Exploration success continues to bolster the growth outlook. The recent Omega Alpha campaign delivered a significant oil discovery in the Yggdrasil area, with estimated recoverable resources ranging from 96 to 134 million barrels of oil equivalent, MMBOE. 2. This represents one of the largest discoveries on the Norwegian Continental Shelf in the past decade. 2. The economic significance of the Omega Alpha discovery is multiplied by its proximity to the existing or planned infrastructure of the Yggdrasil hub. Discoveries made proximal to major developments drastically improve the economics of the new reserves. These barrels can be integrated into the existing field architecture as tiebacks, which requires lower marginal capital expenditure than developing standalone fields. This integration maximizes the efficiency of Aker BP's reserve replacement ratio and significantly enhances the overall net present value, NPV, of the consolidated Yggdrasil area. This ability to capture incremental, low-cost barrels near existing infrastructure is a material competitive advantage. 5. 3. Analyzing project cost increases. Investor scrutiny often focuses on capital project cost escalation. Aker BP's portfolio of ongoing development projects increased its gross investment estimate by 75 billion, bringing the total to 288 billion. 9. Management provided a detailed justification, clarifying that the increase is primarily driven by two factors, neither of which fundamentally jeopardizes the project's return profile. Currency effects. More than one-third of the increase is directly related to the depreciation of the NOK against the USD. 9. This is a reporting effect, not an underlying physical cost increase in USD terms. Value-enhancing scope changes. The remaining portion of the increase is attributed to scope changes, including the integration of East Frigg into the Yggdrasil development. 9. This integration is projected to yield estimated revenues from the Yggdrasil area alone that are more than NOK 100 billion higher than previously expected. 9. In conclusion, the increase in investment is directly proportionate to the material increase in expected lifetime revenues and the effects of currency translation. Management maintains strong control over costs and progress, confirming that the project's internal rate of return remains robust and that the overall resilience of the capital program has been strengthened since the initial plans for development and operation (PDOs) were submitted. 9. Valuation assessment and peer benchmarking. 7.1. Analyst consensus and price target dispersion. The analyst community currently holds a neutral consensus rating on Aker BP. 5. This rating is derived from 17 analysts, with 10 recommending hold, 4 recommending buy, and 3 recommending sell. 5. The average 12-month price target is NOK 261.41.5, representing a modest 4.07% upside from the current price of NOK 256. 15. However, a closer examination of the price targets reveals significant dispersion, ranging from a low estimate of NOK 195 to a high estimate of NOK 315. 5. This wide range is a critical indicator of market uncertainty surrounding two fundamental long-term variables: the success and timeline of major capital projects, especially Yggdrasil, and divergent long-term oil price deck assumptions used by different firms. Analysts who assign sell or low hold targets are likely factoring in a higher probability of project delays or a lower long-term commodity price environment. Conversely, buy recommendations, such as the NOK 315 target from Jefferies 5, suggest a higher conviction in successful execution and superior long-term oil price assumptions. The conclusion is that the market is currently over-discounting the probability of successful project delivery. A favorable investment decision hinges on the belief that Aker BP's operational strengths mitigate execution risk, justifying a valuation closer to the upper quartile of the target range. 7.2. Multiples analysis, EV/EBITDA versus PE. For an E&P company in a high-growth, high-capex phase, the enterprise value to EBITDA, EV/EBITDA, multiple is the superior metric for comparing intrinsic operational value. EV/EBITDA analysis. Aker BP trades at an LTM EV/EBITDA multiple of 2.2x. 6. This is significantly attractive when benchmarked against the broader energy sector median of 4.0. 6. A low EV/EBITDA multiple suggests that the company is either undervalued relative to its cash-generating potential or is facing significant near-term headwinds. Given the strong CFFO and defined growth plan, the former is the likely interpretation. The company's LTM EV/EBITDA of 2.2x also compares favorably to its own 5-year average EV/EBITDA of 3.0x 2020-2024. 6. PE analysis. The reported PE ratio of 18.7x15 appears elevated for an E&P business, which might superficially deter investors focused solely on statutory earnings. However, as previously established, this high PE multiple is heavily distorted by the significant non-cash depreciation, depletion, and amortization charges resulting from the capitalization of the multi-billion-dollar development program. Therefore, the PE ratio is not representative of Aker BP's fundamental cash flow generating capacity. 7. 3. Comparative valuation multiples LTM. Relative valuation analysis shows Aker BP trading competitively against its peers, particularly given its superior organic production growth pipeline.